The ripple effect is felt all throughout the markets and crypto alike. What's getting impacted the most, and what's this mean for your wallet? Plus, our eToro investment analyst Callie Cox is here with her 3 biggest takeaways from the Fed rate hike. Is the controlled burn turning into a forest fire? It's Thursday, June 16th. Subscribe below, hit the notification bell, and let's get into it.
The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate.
Wow.
What a soothing guy. I listen to him all day. So the Federal Reserve, guys, is making some big moves, as we just heard from Jerome Powell. They decided to raise interest rates by 75 basis points. And like we said in the intro, the biggest hike since 1994. I was 3 years old then. So why did the Fed why is the Fed doing this, and is it going to impact you? Delano, kick us off on this one.
You know, he just mentioned it, Zay. The Fed is doing this because there's 2 mandates that they have to focus on. One is keeping us all employed, or as much of us employed as possible. The other, to have price stability. And right now, price stability is out of control. And how do you rein that back in a little bit? You have to raise rates. You have to slow down demand a little bit, and that's what they're doing. But can they actually slow down demand at a pace that won't push us into recession? That is the big thing you're going to be hearing about right now, the soft landing. As you see this chart right here, prior to August of 2019, the Fed was raising rates at a steady 25 basis points, or 25 bips, the cool finance people say. They squish words together and make it sound cool. But in drastic times, it calls for drastic measures. So during the pandemic, we acted swiftly and we lowered those rates, as you see in the graph over there. And then also now we're at different times where inflation and price stability is out of whack. We're going to increase the rates. The Fed is using those policies, Nicole, to kind of, help our economy, but we'll see if it's going to work.
Right. The Fed's decision to raise its key interest rate by 0.75 percentage point is, good news for savers, but less so for borrowers. So this is how it can really impact you, right? As a borrower, you can expect to pay more on credit card debt, car loans, and certain student loans. But let's talk about credit cards. So for credit card rates are closely linked to the Fed's actions. So consumers with revolving debt can expect to see those rates rise, usually within 1 or 2 billing cycles. The average credit card rate was recently 16.73%, according to bankrate.com, and that is up from 16.34% in March. So we'll be feeling a little bit of the pain, I guess, if you will, here. But we'll see. I am always hopeful that all of this will be right for the greater good, in hopes that we don't push ourselves into a recession.
Well, I mean, look at again, the Fed has one thing on its mind, and Jerome Powell mentioned it. They have to tackle inflation. Yeah. Inflation is, at 40-year highs. The CPI for May was 8.6%, highest since the early 80s, right? Mm-hmm. And the Fed has to raise interest rates to get that under control, because when you raise interest rates, that increases borrowing costs, like Nicole talked about, and that should reduce spending, and the reduced spending should bring down inflation. That's what the Fed is focused on, even if it results in a slowdown of economic activity, even if it means higher unemployment. The Fed has to get this under control. Jerome Powell specifically mentioned it in his press conference, that they have to get prices to be stable again. So that, to me, is a big thing. Obviously, it's already had an impact on the economy, them raising rates. We talked about this yesterday with 30-year mortgages. I mean, it's at over 6% now. A 30-year mortgage is at over 6%. Just 6 to 7 months ago, you could get a 30-year mortgage for around 3.5%, even less than that. And now you can't get that anymore. So it's already having an impact on the economy, and it's probably going to continue to have impact. I just wonder if they can kind of navigate this soft landing that we keep hearing about, because it's getting more and more trickier.
It is getting more and more trickier. And I think part of me is thinking like how much of damage is already done, because raising the Fed's funds rate is obviously that short-term borrowing rate for banks, and that feeds through to everything else, but that takes a little bit longer when you talk about credit cards and mortgage rates. So everyone is already feeling a lot of the pain of inflation, and that's going to be eroding salaries and incomes for a little bit, and they're making these actions to raise rates faster and more aggressively. But people are probably wondering how much of the damage is already done. Is there anything left that can be done? They did kind of give projections and an outlook on where they think inflation is going to land, the rate will land of growth of inflation for the next, back half of the year, which was a lot lower than people expected. And they actually took out, in their statement, they actually took out, the indication that they expected inflation to return to its 2% objective and the labor market to remain strong. They had that in the statement prior. They took it out this time. They said they're strongly committed to the goal of having inflation return to that 2% objective. So things are getting a little bit less clear as you kind of go down the pipeline, Zaid and Nicole. It's going to be really, really something we have to watch.
I would add the uncertainty, I guess, and it feels fast. Like it feels like all of this has been happening kind of rather quickly, even if in reality it hasn't. But we had the pandemic and we had that recessionary economy, and then things opened up again and things were feeling so good, right? Like, and now we're kind of back here in this state of like, oh, the world's opened up again, but now we're in this economic downturn and feeling that pain again. So it's just the ping pong ball here is moving fast. So hopefully it'll move fast in a better direction. But a lot of thoughts from us. But what does an economic analyst think? Well, good thing we've got one that is ready. Here's eToro's investment analyst, Callie Cox, with some hot takes on the Fed.
Everybody's talking about what happened at the Fed meeting yesterday, and it could be a turning point for the economy. So here are my 3 biggest takeaways from yesterday's Fed meeting. 3, the Fed is going sicko mode on inflation. The Fed hiked 75 basis points in a fairly surprising move, given that just last month, Powell said that rate hikes bigger than 50 basis points were off the table. Powell made it clear that he and the Fed want to see inflation come down, even if it comes at the cost of more growth. It's an oddly bold strategy considering demand is starting to slow and recession fears are high. Plus, the Fed can't control certain causes of inflation, such as the Ukraine crisis. 2, a bigger hike now doesn't necessarily mean smaller hikes later. The Fed seems to have no intention of slowing down here. The Fed's latest projections even show that they expect to enact 7 additional 25 basis rate hikes before the end of the year. This could prove to be a mistake. Rate hikes notoriously take some time to flow through the economy, and the Fed isn't willing to wait. In the push and pull between a hot and cold economy, the Fed seems more willing to let the economy edge closer to recession than to overheat. And 1, this controlled burn may be turning into a forest fire. The Fed started this fire to tame inflation and get the economy back into balance. That makes sense. But going laser focused on inflation may prove to be a costly mistake. And it's clear that the Fed is fighting the flames on its back feet now. So if this really is a controlled burn that's turned into a forest fire, as the Fed's desperation suggests, this may be another wave of angst in the stock and crypto markets. Because even if we avoid a recession, it seems that growth will likely slow from here, which could make the future difficult for high growth assets.
Wise words from Callie. I think the one thing that stuck out to me is there's so much focus on what the Fed is doing and how aggressive rates are being raised. And I think a lot of it's based on companies, especially growth companies, were doing such great in a time of cheap money, which we had, lower rates and ability to discount at a different rate. And so that allowed for growth companies to have a boom. And now we're in a different environment. So you've seen that all across the board. So we're really hanging on that hinge of the Fed's in, Nicole. So it's really, really curious. I'm really, really going to be watching what happens going forward.
Mm-hmm. Yeah. Well, hopefully this is maybe like a one moment of the sicko mode, which I appreciate that Travis Scott reference there, Callie. But hopefully it's kind of like one of these moments where, oh my gosh, it's intense, and right, we'll have that soft landing as we've been talking about. That's my hope. That's me being optimistic, and I think it's kind of the point, is that we face a little adversity now. We'll experience a cool off and things be a bit better in the long run.
I'm a bit more skeptical, guys. I mean, I think that yes, obviously, like I think they're going to have to continue raising rates.
Oh.
I think the projected rates is supposed to be in the 3.5% by the end of the year. And I just don't know if. See, the thing is, the Fed can continue raising rates, but there's still some things that are contributing towards inflation that the Fed doesn't have control over, like things like supply side rated price hikes, especially in energy. So all those factors might still lead to a situation where we are entering a economic slowdown, or I don't want to say the R word, but a recession. We might be headed towards that way. Callie mentioned that at the end of her segment, that obviously growth is going to be hit hard. They've already been hit hard. But if we do enter into a recession, then it's going to keep getting worse. I hope that doesn't happen, but it's I'm getting bad vibes.
Yeah, it's curious that they actually revised last quarter's GDP numbers to be flat versus 1.7. I think contraction of 1.7%, because technical terms, you get that 2 quarters of negative, then you're obviously in that technical terms of recession, right? And so we revised it. A lot of people are hinging on that. Maybe it's 2023 where we'd see it, or back half of this year if we do see it at all. Again, we don't have a crystal ball, but it is something for everyone out there to be watching.
Absolutely. Well, that does it for the show today. Hopefully a little more optimistic tomorrow. So stay with us and we will see you then. Be sure to like, comment, and subscribe, and see you tomorrow.
See you tomorrow.
Be out.
Hey y'all, thanks for watching. Make sure you tune in every day. Also hit that like, subscribe, and notification buttons. We'll see you tomorrow.